The biggest fear for the US is not China selling US treasuries, but rather Japan suddenly collapsing. Once Tokyo takes action, the global financial market could crash within 72 hours, affecting your mortgage, pension, and even your grocery budget. Japan is the real ticking time bomb in the US Treasury market. China reducing its holdings can be managed by the US, but a sudden sell-off by Japan would trigger a global financial tsunami. Why? Because Japan holds $1.1 trillion in US Treasuries, and all of it is on leverage. Once it detonates, Wall Street, the Federal Reserve, and even your wallet would be affected. Let's look at some shocking data. According to the latest data from the US Treasury in May 2025, Japan holds $1.13 trillion in US Treasuries, nearly $500 billion more than China. Even more alarming, the Bank of Japan uses 20 times leverage on these treasuries, essentially betting $100 to stake $2,000. If the market collapses, it would lead to total losses. Currently, the Japanese government itself is a giant debtor, with its national debt representing 263% of GDP, even crazier than the US. What does this mean? Japan is not an investor but a gambler. The US treasuries in its possession are not for profit but for survival. Once the yen collapses and the economy cannot hold, the Japanese government will not hesitate to dump US treasuries for dollars, triggering a direct earthquake in the global financial market. Imagine this terrifying scenario. On the first day, the yen plummets, and the Bank of Japan urgently sells $30 billion in treasuries to stabilize the market. The prices of US treasuries crash instantly. On the second day, hedge funds go bankrupt, Wall Street frantically sells stocks, and the US stock market drops by 5% in a single day. On the third day, global dollar liquidity dries up, causing chaos in the renminbi, euro, and gold markets. Your investment products could evaporate by 10% overnight. This is not alarmist. A similar event occurred in April 2025 when Japan sold only $5.8 billion in treasuries, causing the yield on 30-year treasuries to spike by 20 basis points. This crisis directly affects the lives of ordinary people. Mortgage holders need to be cautious. A collapse of US treasuries will lead to soaring interest rates, with 30-year mortgage rates potentially breaking 9%, leading to a 40% increase in your monthly payments, while pensions will shrink. This is because the Social Security Fund has 28% of its overseas investments tied to US treasuries, which could evaporate hundreds of billions in 3 days, leading to skyrocketing prices. A dollar shortage would cause the prices of imported chips, oil, and food to rise. Electric vehicles could become $20,000 more expensive, and oil prices may return to the $10 era.